Welcome to the African Allocator podcast. I'm your host, Chipomuwawo. My guest today is Django Davidson, founding partner at Hosking Partners, a London-based investment manager that runs a global equity strategy focused on the capital cycle approach to investment. We'll talk about what exactly that means in a few moments. But welcome, Django. Welcome to the podcast. Really great to have you.
Thank you for having me on, Chippo.
I'm going to ask you a question that I always start with. I'm keen to hear what got you into investing. How did you end up in the industry? Tell us more about your journey to this point.
So I joined the industry after university. I joined Deutsche Bank, aged 22. Didn't know much about investing, but was very keen to get into, in inverted commas, finance. And I kind of quickly came to the view that in finance, if you kind of want to express your, if you want a sort of intellectual approach to finance, being on the buy side is the place to be. I started off as an investment banker and then transferred into Deutsche Bank's equity research team. And that was a great education. You learn a lot from doing corporate finance, but you do sell your soul, working until, midnight every night in your early 20s is kind of, it's only so long you can do that. And I moved into banks equity research at a very fortuitous time. It was 2006. We're in the kind of run up to the financial crisis. And I learned a little bit about banks in the run up to the GFC, and when the crisis hit, I was the bank and people that understood banks were in great demand, and in the land of the blind, the one-eyed man is king, and it was that that experience of knowing a little bit about banks during this extraordinary time that really got me interested in moving on to the buy side and actually expressing these views as an investor.
Thanks for that. That's really interesting. I'd love to just hear a bit more about Hosking in particular. So, what makes the firm special? It sounds like you're doing something different to what many sort of classic managers are doing at the moment. Talk to me about that.
We got a different way of looking at the world. We're not a specialist in any area. We're global generalists. So the first advantage that gives us is we can go anywhere. We can compare Microsoft to a Sri Lankan cement company. We can look for contrast around the world. We can go across the capital spectrum. So that go anywhere approach, which applies to geography, which applies to capitalization, which applies to sector, is a real advantage in looking for contrasts. The second feature is that we have this multi-counselor approach. So there are 4 investors, myself, Jeremy Hosking, Luke Bridgman, and Omar Malik. We each manage a sleeve of the portfolio, which leads to our third advantage, which is that we're diversified. We've got over 350 stocks. We have many clusters, which are effectively one idea, but expressed through a cluster of stocks. So when you're looking at these capital cycles, take, for example, copper mining. We have about a dozen copper mining investments. And the reason for that, Chippo, is in industries like mining, where you have big immovable objects like mines in geographies that can be challenging either politically or geologically. You want to diversify your risk so that if you're approximately right that there's a looming supply shortage of copper, you're not precisely wrong by expressing it in one share, which might, for example, be subject to nationalization or a mine stoppage, as we saw recently with First Quantum in Panama, or a geological incident, as we saw recently in the Congo with the Kamula-Kakoa. So we have a tolerance of a large number of shares, which many of our peers don't, and it's a kind of marketing disadvantage to have a lot of shares. People like concentrated portfolios, but it's a benefit, we think, in terms of expressing long-term capital cycle investing.
Can you share a couple of examples of sectors where you're seeing this oversupply, undersupply narrative play out? You've touched on mining, so maybe we talk about mining first.
One of the things that will be close to close to your heart as an Africa specialist is the platinum, palladium, PGM sector. 90% of the world's platinum is in South Africa or Southern Africa, including Zimbabwe. Just under half of the world's palladium. This is a very rare metal. It's about 1/20th as prevalent in the world's crust as gold, for example. So it is a genuinely precious metal. This is a sector that has been underinvested in for over a decade. For the last 10 years, the PGM miners who've been suffering with a low basket price have underinvested in their assets. Now, mines naturally deplete. These mines, particularly South African ones, are very deep anyway. They're up to 2.5 kilometers deep. We went down late last year. It's an extraordinary experience. And these mines have not been fully invested in such that the supply of ore going forward is falling, and it's going to fall off quite dramatically. So what attracted us to this, Chippo, was this falling supply, this supply curve that tails off quite rapidly from about 4.5 million ounces of platinum down to about 2 million by 2040 if we don't refill the lost supply. And so what that means is you can be relatively, not completely, but relatively agnostic as to what's happening with demand, because all else equal, as we mentioned earlier about the capital cycle, the lower the supply, the more the less capital employed in the industry, the more restricted the supply, all else equal, the higher returns for the remaining capacity. What gave us the opportunity, and this is how the capital cycle of an industry interacts with the stock market, is the stock market often, which, as we all know, is prone to extreme mood swings of pessimism, greed. The stock market became very pessimistic about the outlook for demand for PGMs. The stock market, which is a discounting machine, started to embed a lot of forecasts that the main demand for PGMs, which is also catalysts used in internal combustion engines, it's about 70% of end demand, would go away, would go the way of the dodo as EVs took over. And the last couple of years have seen that view, that demand forecast, radically reappraised. And actually, you look at the most recent example of kind of policy, the one big, beautiful bill, we're seeing that the subsidies for EVs have been cut. They used up until the end of this month, you can get a $7,500 subsidy for an EV in the US. From September onwards, you won't. You have to pay full road tax. I think the federal government's sort of, I think they've told the US Post Office to get rid of its EV fleet. The direction of travel on EVs, which has been this huge support, see a huge amount of support from Western governments, is flipping. And it's not clear that without the subsidies, the demand for EVs will be as high. One of the stats that really got me interested in this whole sector was from a friend of ours called Rob West, who cited some research that said, well, the average US, if you segment the US household into buckets of income, you segment it into 7 buckets from the lowest level of income to the highest. It is only really the highest top 7th of the population that are significant purchasers of EVs. And in fact, the single biggest statistical determinant of whether you have an EV is whether you have 4 or more cars. So for families that are wealthy enough to have 4 cars, their 5th car they're highly likely to have an EV. I think there's a 50% probability of them having an EV. Exactly. And so that explains this idea, which we're going to see, which we see in the US, and I imagine will be even more prevalent in countries with difficult logistics and lower incomes, particularly in Africa, for example, that EVs need huge amounts of subsidy and wealthy customers in order to see great adoption. Without those two things, the outlook is less is less clear that we move rapidly to EVs. Mm-hmm. And the point of this is that with this supply curtailment and an uncertain outlook for EVs, this idea that we move to a full EV fleet by say 2030, which was a sort of mad idea of the British government, seem keen on promoting. That's been pushed back at least a decade, perhaps even a generation. As the supply, so this is the capital cycle at work. As all this underinvestment over the last decade, management teams, have underinvested. They were listening to investors tell them that they wouldn't have a future, and so on and so forth. As these supply curves fall off and we don't have enough ore, the price of PGMs is rising as people reappraise how long this industry has, and the price is rallying. So we wrote about this in November of last year when the PGM basket price was about 900. It's moved up to about 1,400 now. And the mining companies, which is how we express this, we have a basket of 5 PGM companies, has responded really, really positively to this. But we're very early in this innings. These decade-long underinvestment cycles take a long time to play through. The price will have to stay high for a long time for us to see new supply come online. And in the meantime, the returns for this industry are going to rise very significantly, I think.
I've got a couple of questions. One is just about exit. You're taking a long view on these investments. As the, supply picture starts to change within a certain particular industry, at that point, are you looking to exit, or what's your sort of rationale? How do you approach realizing returns on your investment?
So we have a saying here that demand is storytelling, but supply is measurable. And that's why we focus so much on demand. So what would make us change our view is if lots of new supply were to come online and the deficits, which the minute they run at about 1 million ounces, it's about 15% of total supply is in deficit. So each year, all of these above ground stocks, of which there are significant stockpiles, are being eaten through. If that deficit were to turn into a surplus because, for example, lots of new mines were to be brought on, we would have to look at this industry very differently. So what we look for is the supply picture, the supply numbers being, materially altered through the addition of new capacity, new mines in this instance. It takes a while for that to happen. You get quite a good kind of line of sight on this happening. There are some new projects in PGMs. It's not without new supply. We've got Platte Reef coming online in the 4th quarter of this year. It's a fantastic ore body. In the long term, it will produce a lot of platinum. But in the short term, it's relatively minor in the grand scheme of these very sharp and declining supply curves from the rest of the industry, a large proportion of which is very deep and very difficult to add new supply to.
I had a question about narratives, because, you talked about the kind of expectation around EVs over the last few years and how, that seemed to suggest the death of platinum and, all this stuff and all metals like that are used in internal combustion engines. How do you, stay strong in the face of very strong narratives?
The mental model, the framework, the sort of window that we use to look at these industries is the capital cycle. And it gives you a terrific set of guardrails for being, for making sure that you're improving the quality of your decisions when you come up against these great manias, trends, market narratives. So using capital cycle theory, if an industry is attracting significant amount of capital, if the promoters of the industry are raising substantial capital at high valuations, if the promise of the industry is a demand-led story where perhaps there are question marks over the profitability of that story, then those features as capital cycle investors would make us very unlikely to invest. So not that there are, not that, for example, OpenAI is listed, but all of the features that I've just outlined are present at, for example, OpenAI. Mm-hmm. And that doesn't mean that, I've got the capital cycle gives me a window into whether AI will, in its current form as constituent, as as expressed by OpenAI as a good or bad investment. It just tells me to be very cautious about investments in that space. You could add on to that the circa 100 billion plus capex, the US dollar capex bills for many of the hyperscalers. These are huge numbers. All else equal, the more capital goes into an industry, the lower returns for all of those participants. So there are reasons to be skeptical as a capital cycle investor of this current AI wave. That doesn't mean that, AI isn't AI. I mean, I don't know, we need to be very specific about the terms here, but it doesn't mean that in the future there will not be killer commercial applications for AI. I think it just means, people like us would be very nervous about expressing it in companies with very large market capitalizations, which appear to be competing with each other for the first time in their history.
Although Hoskins doesn't have an explicit EM mandate, emerging markets, form a sizable chunk of your allocation. Why is that? Why do you think that's where you find a good amount of opportunities?
So this goes back to that point we made earlier about one of our kind of differentiating features is we have this go anywhere global generalist model, which is tolerant of a large number of shares. So that means we really can invest anywhere at any capitalization in any sector. And that's our great kind of edge. That's our kind of USP. And what that allows you to do, Chippo, is compare stocks in countries that are out of favor or not particularly well researched with shares in other areas of the world which are very well researched, have very high capitalizations, and which, certainly at the minute have very high valuations. So a good sort of live example of this would be in 2024, we went out to Sri Lanka. The company had just been through an IMF program. It had had its first sovereign default. The valuations in US dollar terms, because we had a 70% fall in the stock market in US dollar terms, were kind of Great Depression level. We've got no mandate to be in EM. We're global generalists. We don't have to be in EM. But one of the kind of heuristics that we follow is that when there's a crisis, you should get on a plane. When money is literally leaving the country, as it was during the Sri Lankan crisis, the sovereign default, that's normally a good time to look for bargains. And we certainly found them in 2004. And the contrast in the valuations of these stocks versus other large global companies was incredible. We were able to buy a cement company at around a fifth of the replacement cost. We're able to buy leading hotel chains at around a third of replacement cost. We use a pretty simple valuation frame. We don't build huge discounted cash flow models on every single one of our companies. Sometimes they're useful. We're not dismissing them, and we do use them. But broadly speaking, if we see a really stark discount to the replacement cost of the assets of a company, and we have reasons to believe that this will be temporary, we're interested because it's a terrific barrier to competition. If the company is valued at a fraction of replacement costs, let's take the Sri Lanka example. If you can buy the premier hotel in Sri Lanka at around a third of what it would cost to build a new one, well, you would never build a new hotel as a competitor. Why would you? Just go and buy the existing one for a third of the price. And so there is a way in which the capital cycle plays a very important role in understanding how these valuations mean revert. And so in emerging markets where you are the countries are much more prone to crises, the amplitude of these cycles can be much more can be much higher on both the up and the down. We find them a really fertile ground for what we do. Now, the last 10 years has not been has not been very kind to emerging markets. It hasn't been very kind to this kind of investing. But that notwithstanding, we've managed to do pretty well in these markets by focusing on these areas of crises, by being disciplined in applying this replacement cost analysis. And the forward-looking returns from lowly valued EM shares in a global index that's dominated by the big companies. I think I read that the top 10 equity companies are 25% of the index or something. That's pretty concentrated. It's kind of, are you getting your diversification benefits there, to be discussed? If you can actually put a reasonable amount of your portfolio into very lowly valued EM companies that aren't facing much competition and look to have exciting prospects, we think that's going to be really exciting for the next 10 years.
The capital cycle approach seems to fit contrarian minds. How do you distinguish between a true contrarian and someone who just says they are?
It's one we've given a lot of thought to. My personal view on this is that contrarianism is the one thing you cannot teach. I think it was Lenin who said, "Give me the boy until 7 and I'll give you the man." This idea that, I think your kind of early brain chemistry is a significant determinant of whether you're a contrarian thinker or not. I think if you are a contrarian by default, and, my wife constantly tells me I'm an extremely annoying contrarian, which is not necessarily great to live with. But if you are a contrarian, you want to put in place some guardrails that stop you just being instinctively or reflexively contrarian. And I talked about the capital cycle being a helpful framework in that regard when it comes to looking at bubbles, and also looking at investment opportunities. You need to structure your life in a way that you're contrarian and right, because there's no point in being contrarian and wrong. If you're one of these people who, when someone says turn left, you just turn right for the sake of it, well, oftentimes you might get in trouble. So what's so important about being a contrarian is to understand yourself. This above all, till I know itself be true. Understand why you're contrarian, and how it will impact, decisions you make. It's a source of sort of endless interest for me personally, and I do lots of reading on this subject because I think if you can harness it correctly, it's an incredibly powerful sort of brain makeup.
A couple of questions to end. As you look ahead to the next sort of 12, 18 months, I'm conscious that, you're looking at investment horizon in sort of multi-years and decades. But the next 12, 18 months, what's one reason for optimism and one reason for caution, just as you look at markets generally?
Well, I think a reason for caution would be valuations of large global shares do seem to reflect a view that inflation has peaked and interest rates will come down. I mean, interest rates are driven by inflation. And so there is this view that like inflation is tamed. And I don't know whether that's true or not, but history would suggest that these cycles are very long, and inflation is always and everywhere a monetary phenomenon, and there's a lot of money about. So I would say that's one reason for caution, is the world thinks interest rates are going to come down, and they might not. I think the reason for optimism is that whilst there are big pockets of overvaluation, we've got a very concentrated market, and certain themes are doing very well. Outside of that, there are whole areas of the world, whole sectors, and whole spectrums of the market, particularly the smaller end of the market, that have been kind of ignored, underinvested, not really analyzed in great detail. And we kind of lost a lot of the muscle memory that was built up around that. You talked about emerging markets. I think that's a very good case in point. And so if you've got the ability to kind of stay away from the stuff that is overvalued and potentially at risk from overvaluation, and if you've got the ability to invest in and turn over the stones in these weird and wonderful bits of of the world, I think you could have a really exciting and very differentiated investment outlook for the next decade.